Howdy everybody, Professor Martin here coming to you from Wilmington, Ohio. If you're taking a look at our video today, you're probably somewhere in the process of learning how to analyze financial statements. And what a great thing to learn. I tell my classes all the time, this is one tool that you're going to have that will benefit you in all kinds of different walks of life. You know, whether you go on to be an accountant, whether you in a managerial capacity in government with a private corporation, or even just in your personal life, learning how to understand a financial statement so you can make an investment. All right, so all kinds of applications here for what we're talking about. In our video today, we're going to be focusing on vertical analysis, which is a part of financial statement analysis. Now, you hopefully tuned into the other video that we've had on the topic so far, where we talked about horizontal analysis. Both horizontal and vertical analysis are types of what we refer to as common-sized analysis. In a common-sized analysis, we just take all the items on the financial statements, all the accounts on the financial statements, the income statement, the balance sheet, and we express them as percentages instead of dollar amounts. And so in our video on horizontal analysis, if you haven't had an opportunity to look at that yet, I suggest you go check that out and you'll kind of understand what I'm talking about. When we say horizontal analysis, we were talking about going left to right or right to left on the financial statement. And we were looking at those year-over-year trends and kind of trying to show them as a percentage. And we'd say, okay, well, net sales went up 9.1% from 2021 to 2023 at Walmart, for instance. We take every line item or every account on the financial statements and we express them as a percentage of a base period. And we talked about how the base period could be an early period or last year. And we can kind of get some percentages and have a really good understanding on what's going on. So that's where we were at with horizontal analysis. Really simple math involved. You know, we just kind of took 1 year, divided it by another, multiplied by 100 to get a percent. And that is our horizontal analysis. That's where we've been. Where we're going today is vertical analysis. We're looking at the relationships among the line items, not year to year, but the relationship among line items on the financial statement within a given period. So horizontal is looking at year over year, vertical is looking in one period. So how's that going to work? You know, I got the income statement for Walmart right here. In vertical analysis, we're going to go up and down that income statement. What we're going to do is going to help us see all the relationships between these line items. We're going to express every item on that income statement as a percent of net sales or total revenue. Usually if you have a financial statement that only has one revenue item like net sales, and you take everything and divide it by net sales. But if your business like Walmart has multiple categories of revenue, then you probably use total revenue to do your vertical analysis. So what we're going to do on the Walmart financial statements here, on the income statement anyway, we're going to divide every line on that income statement by total revenue. Real simple, dividing one number by another. When we get to the balance sheet, we'll divide every number on the balance sheet by total assets. And you might be kind of curious and thinking, okay, well, why are we doing that? What's the point? I'm going to show you the math and we'll talk about why we do that as we go along. So vertical analysis on the income statement. We're going to take every line and divide it by total revenue. You can see going up and down, taking every line and dividing it by total revenue. All right, here we go. Let's just kind of use cost of goods sold as an example. You can see my cost of goods sold line there. Again, we're looking at things within the period. We're not looking year to year. We're not mixing the years up here. We're just going straight up and down the column for every year. So year one cost of goods sold. You can see we have 420,315. And that would be 420 billion because our numbers are in millions. But just for our math purposes, we'll say 420,315 divided by total revenues of 559,151. And then we'll multiply that by 100 to get our percent. We do that, we get 75.2%. What will we do for year 2? Well, for year 2, we take 429,000 divided by 572,754. Multiply it by 100, we get 74.9%. Year 3, 463,721 divided by 611,289 multiplied by 100 gives me 75.6%. And you say, okay, big deal. I got a bunch of percentages. I don't understand what those mean. Real easy to understand. I want you to imagine every dollar of revenue. Just think of $1. Walmart sells a $1 product at the register. Okay? A person pays for it and walks out. Gives Walmart $1. Of that $1, in year 3, 75.6 cents of that dollar went to cover cost of goods sold. In year 2, 74.9 cents of that $1 went to cover cost of goods sold. You get the idea? So what we're doing on the income statement, we're looking at, imagine $1 in revenue, and we're looking at the percents of these expenses and where that $1 is going. And so if we look at the trend here, in year 1, 75.2 cents of every dollar went to cost of goods sold to cover that expense. In year 3, 75.6 cents of every dollar went to cover cost of goods sold expense. And so you can see that's going up. That's eating up more of that sales dollar. The more these expenses eat up that sales dollar, the less we have in profit at the end of the day to put into our pocket as a Walmart shareholder, a Walmart company. Okay? You kind of see how that works? And so if we did it line by line, we could see how these expenses are maybe growing and sucking up more of the dollar of sales. Or maybe they're decreasing, freeing up more of that dollar to end up in our pocket as net income. And so just like we did in our horizontal video, we're going to pull up the Excel spreadsheet, the income statement for Walmart. And I'm going to show you how to do the math in Excel so we can quickly do vertical analysis and determine what these expenses are doing as far as eating up that dollar of sales. So let me pull up our spreadsheet here. There we go. You can see that okay. We'll start on year 1. We have year 1, year 2, year 3. You can see the income statement information right there. We'll zoom in a little bit so we can see better. And we're dividing every line on the income statement by total revenue. Okay? So we'll start right here at the top. Net sales. I'm going to divide that by total revenue. And I'm going to do one little tweak to my formula here. We want to make it an absolute reference. That way when I copy it, it doesn't move my reference all around. I always want to reference total revenues as the line I'm dividing by. So I'm going to hit F4 on my keyboard. You'll notice I get a $ in front of both the F and the 6. Now I can copy that reference around. We'll turn that into a percent, 1 decimal place, and then we'll just copy it down all the way through there. We'll do the math all the way through, and then we'll talk about the numbers a little bit. So again, we're taking every line on that income statement, we're dividing it by total revenue. Make it a percent. No need to multiply by 100. If we have Excel, we can just make it a percent format. And then finally, dividing every line in the year divided by total revenue. Make it a percent. Carry it on down, get rid of the junk. There we go. So right off the bat, we have 2 different kinds of revenue at Walmart. We have product sales and then we have membership sales. If you've ever been to Sam's Club before, you know you can't buy anything unless you have the little Sam's Club card. You got to pay for that every year, like $49, $99, whatever it is. But that's a separate bucket of revenue that Walmart kind of keeps track of. You can see product sales represent 99.3% of their revenue. Membership sales represent about less than 1%, just a hair less than 1%. Together, those 2 equal 100% of revenue. Now, cost of goods sold, we see about 75 cents of every dollar that is sold goes to cost of goods sold. about 20 cents of every dollar goes to operating, selling, general, administrative expenses. So that right there, we're talking about 95, 96 cents of every dollar going to those two expense groups. You have operating income, which is basically our revenue minus cost of goods sold, and selling, general, administrative expenses. That's our operating income. You can see about 3 pennies of every dollar of sales is operating income. And then we take out our interest, we take out taxes, we take out all the other stuff. We get down here to the bottom, net income. In year 3, for every $1 that Walmart had in revenue, they put nearly 2 pennies in their pocket. So not a very big margin there. Every dollar sold, 2 pennies goes into the pocket as profit. All the rest of it is sucked up by expenses. You can see the percentages right there. And so if we're looking at the trend from year 1 to year 3, we can see cost of goods sold is sucking up more of that sales dollar. We can see selling, general, administrative has stayed pretty steady. And we can maybe look down through here. Everything's looking pretty steady. Provision for income taxes is income tax expense. You can see it's gone down a little bit. So basically, that increase, that bump up in cost of goods sold is most concerning. And you think about reasons why cost of goods sold would go up. Well, maybe inflation. Maybe suppliers are charging us more. Maybe vendors are charging us more for the product. Maybe we have shrinkage. Maybe we have inventory disappearing through theft, loss, waste, whatever the case might be. That's a question that we have to dig into. We don't know offhand just from looking at the financial statements. It's probably a combination of all of those things. But right now, it looks like that's the expense that is growing and sucking up more of every sales dollar. The other expenses look pretty flat. So let's go back to our notes here. Now you give it a try. I've given you access to a Target Excel spreadsheet that has the Target income statement data on it. I'd like you to download that, run your numbers, and see if you can do a vertical analysis of Target. Remember, we're going to divide every line on that income statement by total revenue. I'll give you an opportunity to download that, and then we'll come back and we can check your math against mine. All right, so hopefully you've had a chance to do that. If you haven't, make sure you pause. Last chance right now. Here we go. This is what you should have come up with. Looking at Target, you can see pretty similar to Walmart as far as the breakdown between sales and other revenue. You can see product sales are about 98, nearly 99% of revenue, and then a 1% other revenue. Total revenue is 100%. But look at the cost of goods sold. And we saw back in the horizontal analysis, Target's profit really went down from year 1 to year 3. Their net income really went down, even though sales were going up. And we said, cost of goods sold seems to be the culprit there. And it really becomes clear right here. Look at selling, general, administrative. From year 1 to year 3, it went from taking up 20 cents of every sales dollar to less than 19. It went down a full percent. But look at cost of goods sold. From 70% of every sales dollar to 75% or 75 cents of every sales dollar. And so cost of goods sold is really gone up at Target. And again, we'd have to dig deeper to figure out why. Is it vendor passing along cost to Target? Their costs have gone up, so they're charging Target more for the product. Is it theft? Is it shrinkage? Is it poor supply chain management? They're losing products along the supply chain, trying to get it from the warehouse to the store. It could be all sorts of things. It could be a combination of everything. But there's something going on with cost of goods sold at Target that's really hurting them right now. We see it reflected in the net income, net earnings, or the profit on the bottom line. In 2021, in year 1 here, 4.7 cents of every dollar of sales was going in their pocket as profit. That's all the way down to 2.5 cents. So their profits have nearly been cut in half between year 1 and year 3. So, as you probably could have guessed, we don't just do a vertical analysis on the income statement. We can also do it on the balance sheet. You see Walmart's balance sheet right here. We have current assets, we got property and equipment, we got total assets down there. When we do the vertical analysis on the balance sheet, we're going to divide every line item by total assets. And so you can think of all these assets as the total assets as a pie. Cash is a slice of the pie. Receivables is a slice of the pie. Inventory is a slice of the pie. What we're trying to figure out is how big each one of those slices are in respect to the pie as a whole. And so to do that again, we're going to divide every line on the balance sheet by total assets. We'll take inventory, for example, in year 1, $56,511 divided by total assets of $244,860 multiplied by 100. We get 23.1%. What that means is in 2022, inventory, the inventory slice of the asset pie was 23.1% of the whole pie. Now, where would that be beneficial to know? Why would we want to know that? Well, think about inventory. We want to turn our inventory as quickly as possible. We want to get inventory, we want to sell it as quickly as possible. And so if it's typical for a retailer to have inventories at 23% of the total asset pie, maybe we look down the road and all of a sudden inventory has grown to 30% of the pie, 40% of the pie, 50% of the pie. You see what I'm getting at? So now we can say, oh my goodness, our inventory balances are getting way too big. We have too much money tied up in inventory sitting on the shelf that's not moving. Okay, so let's look at year 2 and see what the trend is. Year 2, 56,576 divided by total assets. You can see very steady, 23.3%. So that portion of the pie for Walmart and their total assets, it didn't really grow. It kind of stayed the same. It's going to be pretty consistent, it looks like. We can look at the liability and equity side of the balance sheet. Vertical analysis. Again, we're going to divide every line by, really we're dividing by total liabilities and equity, but if you know enough about the accounting equation, you know already that number is the exact same as total assets. And so I'm just going to say divide by total assets. That way you don't have to remember two different things. But in reality, it's the exact same number as total liabilities and equity, right? So let's look at accounts payable. What portion is accounts payable of the equity and liabilities pie? Year 1, 55,261 divided by total assets or total liabilities and equity of 244,860. We get 22.6%. We jump to year 2, 53,742 divided by 243,197. We get 22.1%. So again, pretty consistent from year 1 to year 2. Do the exact same thing. We'll jump over to the Excel spreadsheet and figure up what the amounts are on the balance sheet for common size analysis here. We're going to take every line on the balance sheet and we're going to divide it by total assets. Again, I'm going to make that an absolute reference. That way I can copy it. Turn it into a percent. Give it a couple decimal places and then just copy it on down. Real quick and easy when we do it in Excel. And I'm all about easy. I like to work efficiently, not hard. Work smart, not hard. There we go. F4, make that an absolute reference. We're dividing every line by total assets. We'll carry it on down. Delete all the junk we don't need. And there we go. And so we can kind of look. We see that in year 1 here, Walmart had 6% of their asset pie in cash. We can see it's gone down to 3%, 3.55% in year 2. Looking for other big dramatic changes here. Property and equipment, you can see it's gone up 3%. And so maybe they've made some investments in stores and they're making those look nicer and neater and brighter and better. In the liabilities part, you can see things look pretty consistent from year 1 to year 2. So that's the idea behind a vertical analysis. On the income statement, we're dividing every line on the income statement by total revenue or net sales if we just have one line of revenue. And on the balance sheet, we're dividing everything by total assets. And jump back to our notes here. Now you give it a try. The exact same spreadsheet that you're working on before. We have a tab for the balance sheet. Go ahead and see if you can do a vertical analysis on Target's balance sheet. We'll check your math against mine. All right, hopefully you've had a chance to do that. If you didn't, go ahead and pause and make sure you get your homework done there. Here's what we come up with. When we do vertical analysis, we can see on Target, the cash account became a substantially smaller part of the pie between 22 and 23. Where'd all that cash go? If we look at buildings and improvements, you can see it went up almost 4% of the total asset pie between 22 and 23. And so, just offhand, it looks like, hey, well, maybe Target did invest a little bit of money. Instead of keeping that money in cash, they invested it in buildings and improvements. So now the pie shifted a little bit. And in fact, if we follow the business news, we can see that assumption is pretty accurate. Here we have CNBC, Target to invest $4 billion to speed along new stores and remodels, expand their ability to fill online orders. They're going to invest about $4 billion over the next few years to speed all that along. And sure enough, we can see about in $3 billion of it right there, jumping into buildings and improvements just between 22 and 23. So our takeaway. Vertical analysis looks at relationships between the line items on the financial statements. We're not going year to year. We're looking in the same period, how the accounts kind of relate to one another. We express all the line items as a percentage in total revenue or net sales on the income statement, or as a percentage of total assets on the balance sheet. That's it for common sized analysis. In our next set of videos, we're going to be taking a look at ratio analysis, and you'll learn a whole bunch of fun calculations that really are going to help you drill down into specific areas of the financial statements and get a good handle for what's going on there. So I'm excited to share those with you. In the meantime, if you're working on your homework or your problems and you have a question, heck, maybe you just got really excited about common sized analysis and pulled up a statement of your own and started doing some math, and something jumped out at you as interesting, you want to share it with me, I would love to hear from you. Feel free to reach out anytime, and we'll come back next time and tackle ratio analysis. Until then, take care, everybody.